right, Jim, I see you. I'm going to make you the presenter now. Welcome back to F.A.C.E, my friend. Just waiting to see your screen, hear your voice. I see your screen. Make sure you're unmuted.
Okay.
I got your voice.
Okay, and
you're showing your desktop right now. There's
okay, can you see?
Yes.
Okay. So
hi, Jim.
Are you kidding? Hi, good morning, Dale. So are we good to go here? I mean,
we're good, yeah.
Well,
yeah,
that was a lot easier than last time.
Okay, well, yeah, because you're not calling in. So you sound clear, so your mic is good. And you know what else has been good, Jim? Your work has been spot on. Viewers from investing.com, if you're not familiar with Jim Welsh, make it a point to become familiar with Jim Welsh and his work. I've been following him for decades. So Jim, nice call on the dollar, a couple of nice calls on bonds, and you have some contrarian ideas in gold. So I'm interested in your views, and just take it away, buddy.
All right. Well, thank you for those nice comments, Dale. I appreciate it. As a quick overview, what I attempt to do is combine fundamental analysis with technical analysis. Not too many analysts try to do that. I'm trying to look at the bigger picture, catch the bigger moves, and I think the best way to do that is by combining fundamental analysis with technical analysis. And when it comes down to trading markets, trying to find reversal points, I think there's a lot of people believe that markets are a discounting mechanism, and you hear that over and over again whenever you listen to TV or even if you read articles and so forth. And honestly, for the most part, I think that's complete hogwash, because if you just look back at various turning points in markets that you have traded yourselves or can remember, the NASDAQ in 2000 when it was above 5,000, what was it discounting for the upcoming year or two? It was not discounting an 80% decline. In 2007, in October, the Dow and S&P made two all-time highs. What were they discounting? They were not discounting a financial crisis. And of course, at the bottom in March of 2009, when it looked like the sky was falling, they were not discounting that we were just about to go into the second longest business expansion in the history of this country. So I really believe that everyone buys into that. It's logical. And as human beings, we embrace logic almost more than anything else. It's like our little comfort blanket. But at turning points, what typically happens is sentiment becomes extreme and positioning becomes extreme. And it happens because when markets trend, slowly but surely, everyone learns the reasons why a market has been going up and down. They finally get it. They then position themselves to take advantage for the trend to continue. And what typically happens is most people are too long at tops and either out or short at bottoms, and they get run over.
Wasn't that one of your biggest factors for seeing the highs in the euro, about 124, 125? Because I didn't see a lot of technicals. It could have been, consolidation instead of distribution, but the extreme positioning on the euro, the extreme bullishness was a big part of your thesis on that position.
Yeah, absolutely, Dale. I mean, you had over 90% bulls. If you looked at the positioning, the large speculators had their largest long position ever. And then from a pattern analysis standpoint, the prior folks who were on, we're talking Elliott wave. I think Elliott wave can be useful. I jokingly say it's useful about 1/3 of the time. And then 1/3 of the time you have 2 or 3 options, and 1/3 of the time you might as well just flip a coin. From the euro standpoint, from its low, and we'll look at the chart in a moment, I think you could count 5 waves up. So that kind of implied at a minimum you were prone for a pullback. So yes, Dale, given the sentiment and positioning, that was a main reason why I thought the dollar was going to rally, because the euro, I'm sure everyone knows, is 57% of the dollar index. So
Right.
we'll just jump in here real quick in terms of looking at the positioning. We're going to look at bonds real quick, and then we'll skip to the dollar and go to gold. In the bonds back in January of 2017, you can see bonds had been declining from the July 16 high, so they had fallen fairly significantly. Bond yields had ticked up from 133 to 260-ish. But looking at the positioning, the red line out of the commercial specs, and as the bond market really started to bottom out, the commercials went really long because, you know, this big decline. Large specs is, aha, okay, rates are going up, I'm going to get on the short side. And so my position was it was time to buy bonds because I felt they would retrace potentially 50% of the decline, and they could rally to 128 to 129 on TLT, which we'll look at in a second. By the time September came, lo and behold, you saw the positioning completely flip-flop. The commercials dropped significantly. The large specs jumped on the long side. I felt bond yields were poised to rise, and that we would see on the 10-year it getting above 260, making a run at 3%. That was a high back in December 2013. And, you know, it took a little time for it to really develop, but in earlier this year, it got going in earnest. At the low here in May, again, you can count 1, 2, 3, 4, 5 down. I felt this was a time, to cover short and then go long, because I thought at a minimum, we would rally back to wave 4 of lesser degree. And looking at the positioning, the commercials got very, very long. The large specs short over 500,000 contracts. So this is one market that, looking at the positioning, can be very constructive. What's interesting is you can still see the commercials
still pretty long.
They really are 668,000 contracts, and the large specs are short. So
so you're going against that because you're looking for a pullback in the bond market here, aren't you? Short term.
Well, what I was playing for, Dale, was, and I'm going to jump to TLT here real quick, is the idea that you had three lows in terms of yields, 3 highs in terms of TLT, all within very, very short distance of each other. On the 30-year bond yield, 295 and change were 2, and then most recently. So to me, it was like, this is the perfect place if one wants to go against the grain. You've got a place where you can put a stop less than 1% by going short and, you know, having a tight stop on it. And I tried that and got run over last Friday on the jobs report. It was stronger than expected, and yet bond yields came down. But we're at a very important point, because if TLT can get above this, I think it implies that we're going to see bond yields stay low for a longer period of time. So to me, the bond market's at kind of
I was kind of thinking, would 128 be a viable target if that's the scenario in TLT?
Yeah, okay. I think so.
All right.
So going back up to these levels here, these notations
kind of a measured move from the low to the resistance, and above it gives you about 128. Yeah. 116,
116.50 to 122. Yeah. You're at 100% right, Dale. So this is, you know, where I went long on TLT, recommended that, selling, then got short. You know, as I said, that trade took a while to develop. It was really frustrating because the 30-year just refused to tick up, and then finally they sold off. And when positioning got very extreme in February, it was time to cover the short. I bought, you know, looking for a move up to here, you know, I mean, so this has been a very easy market actually to trade, looking at positioning and, you know, just the chart analysis. We're at an interesting juncture. because on one hand, you have cyclical inflationary pressures that I think are in fact building. Things like the PPI yesterday, I didn't see the CPI yet this morning. Wage growth is actually picking up despite the labor number that came out last Friday. But countervailing that is the tariffs. On one hand, yeah, they're inflationary too. But on the other hand, look at what we're happening in commodities across the board. So that's really a whiff of deflation that's going on there. We jump to the next one in terms of the euro, as Dale was talking. You know, back in December of 2016, the commercials were very, very long. You know, the euro dropped from what was it? I don't know, 138 or so. It was
140-ish. 140-ish.
Yeah. Okay. And I was very bearish back in 2014.
I remember.
I thought, and thought the dollar was about to rally from 80 up to 95, maybe 101. And it was really based, you know, I won't go into the details analysis, that Mario really had not much to do other than pull the lever of a cheaper currency to try to get inflation going and so forth. So here you can see 1, 2, 1, 2, 3, 4, 5 for 3, and then a 4, 1, 2, 3, 4, 5, 4, 5. So to me, this is why, pattern-wise, there were divergences as this was going on up here. So the technicals were kind of aligning. And look at what the large specs were very short at the bottom. And then as the market went up, they got really pretty long, an all-time record long position, and the commercials will take in the other side.
So what do you do when all these C.O.T numbers compress to zero like they are now?
Well, to me, what it looks like is you got 1, 2, 3, and this might be 4, 5. It may be over, or the euro could be doing a triangle, A, B, C, D, E, and then one more shot down. So this kind of congestion, I personally, would rather sit on the sidelines and wait for this stuff to sort itself out. I mean, to me, from a trading standpoint, Dale, what I want to catch is this move, the wave 3s in the world. So if I can get in near the low of 1 and then get the extreme move, because typically wave 4s, it's going to be a retracement against you. And if it develops into a triangle, now you're talking about a lot of time. And, that just gets frustrating. So to me,
so it's a stand aside to you. Would you be a seller at 120?
I would be more a buyer if it goes down and makes another new low, because then I would feel very confident that, or more confident, I should say, 1, 2, 3, that this is a triangle. Oh, you get a spike down for a 5, then I would be more inclined to take a position in anticipation, looking for a move back up to 120. So, the positioning is improving. You can see the commercials, and they're all, like you said, they're coming to the zero line.
They're neutral.
Yeah.
Just like the market's neutral, the positioning's neutral.
Exactly. So in those kind of markets, I just think, hey, it's more headache than worth, trying to play that game. So, again, the idea here is to catch intermediate to more important turning points. That way, even if you're trading on a short-term basis, if you can identify these major turning points, and you're trading for the next 2 or 3 days, it's nice to know which direction the tailwind is, and that if you're going to do a short trade, you better be careful along the way, to have very close stops, because the tailwind is in your favor. And I think that's where this intermediate type analysis can be very helpful to short-term traders. It's like seeing the forest from the trees. And I think it's very easy to get caught up, in the trees. All right, here's the dollar index. As they were saying back here in February, again, you could count from the January of 2017 high, and I was bearish the dollar at that point in time. It had completed, what I thought was 5 up. It was prone for a fairly good-sized pullback. Sentiment was 90% bulls in January of 2017. And I also thought that we were going to see Trump make some comment bearish the dollar. And he didn't even wait until he was inaugurated. I think it was January 9th he came out and said, you know, in theory, the dollar's a strong dollar is good, but in reality, it really isn't. So anyway, from that January of 2017 high, you can count 5 ways down here. So it's like, okay, we're completing something here. And the positioning, so that chart-wise said, all right, we're near a low. You know, now it's just a question of, are we going to make one more new low or not? But the positioning was very constructive. Again, I don't have, we showed the positioning on the euro. So yeah. I was looking that the dollar would rally based on a decline in the euro, since it's 57% of the dollar index.
Okay, so based upon what you said, based upon what you said in the euro, so this would be a non-trade too, and you'd be more willing to short it at new highs up around 96 than look for it to go to 92 and then buy it.
Yes.
Okay.
Yeah, because again, if the euro's in a triangle and it has a thrust down, that should lift the dollar index back up to this 95.53 high. This is cash that I'm showing.
Right. Okay.
And you know, so
clean out the stops for a third drive, maybe.
Yeah, one of your favorite. Chart
besides 1.618, is there anything I like more?
Nothing more than a third drive. You know.
All right.
And for good reason. It works. I mean, it shows up, with a frequency that's not paying attention to that, and then potentially, if it fails, now you got potentially a little bit of a head and shoulders.
Right.
The dollar dropped 180 basis points. Through yesterday, it retraced about 80. So it hasn't quite done a 50% retracement as of yesterday. So it may go up a little bit more. It may just simply be, hey, this is the first leg of the first correction. That's
what I think.
A rebound, and then going down again. That's been my bias.
Yeah.
That's been my bias.
But I could see both. You always have to see both. So you know where you're, not a bad risk reward getting short on this fib retrace up here, wrong over the double top, something like that.
Yeah.
So what are you doing in gold here, buddy?
Okay. So again, gold positioning back in July of 2016, you can see in December of 2015 here, the lines got really squished. The large specs were pretty negative. Things like managed money, the blue line on this one down here, were net short, which is, they don't do that very often. All right. So I was very bullish on gold here and looking for, a pretty good sized move. By July of 2016, the positioning was, extreme. Everyone got bullish. They knew why gold was going to keep going up. And this is another point. When gold got to 1900 in September 2011, what was it forecasting? Hyperinflation? Or decline from 1900 down to 1040. So again, the idea of the market being a discounting mechanism is a joke. Contrary opinion is far more powerful and a much better aid to trading markets. It's hard though, because you're going against the grain. You're picking up the newspaper and you're reading every day why markets are doing whatever it is they have been doing. And that's why I think looking at positioning, looking at technical analysis can help provide enough conviction to go against the grain. So in this case, I thought gold was topping. It was going to do a fairly good sized correction. As we got to the low in December 16, I turned bullish again because, again, the positioning got very constructive. Sentiment toward the gold got very negative. Again, I think you were down to 10 to 15% bulls. So every time these things have pinched down where the large specs get squeezed out, here's a good case in point. It took out the prior low, cleaning out all the stops. And if you were bullish, a trend line connecting these lows, this decline took you out. And I have felt the last couple months that that's what we were going to see in gold, that if you took a trend line connecting this low to this low, all of it, I thought, it would
1280 breakdown. Yeah.
Yes. Okay. And then there's a trend line from here to here that got taken out. So progressively, what's been happening is, I think, again, people are expecting inflation to come back, but gold isn't responding. And as we take out each one of these trend lines, look at what's happening. Large specs are getting more and more discouraged. If you go back the last 18 months, we're in the second most constructive level in terms of large specs not being long. Commercials, their short position is the lowest since July of last year, which was followed by a $130 rally. The managed money I mentioned before, they are now net short 1,254 contracts. The last time that happened, way back here in January 11th of 2016. So the positioning is constructive. Sentiment, there have been a couple of weeks or over the last couple of weeks where you've had less than 10% bulls in gold. So what I discussed in the Monday weekly technical review was looking at a 30-minute chart of gold, and you had an ABC up to the high at 1265 recently, which implied we're going to go back down again to make a new low. And we got close yesterday. I think potentially gold still has the potential of dropping down, but I would not be short this market because of
silver made a new low, Jimmy, by a penny.
Okay.
Gold held the previous low by $4. So and the gold shares have been acting better. They're not making new lows. So
yeah,
so how much upside are you looking for here? I know you take it day at a time. It's always a process, but what's your vision on this?
Well, longer term, I think potentially Dale, gold went from 1920 to 1040 in December 2015, a decline of $880. I thought the rally up to the July 2016 high was wave A, and that we've been in some kind of a wave B, and that ultimately gold is going to go above that high and reach 50% retracement of that 880 decline. 440 added to 1040 gets you 1480. So I think we're going to see gold go above 1400 before the end of the year. Short term, first gold has to bottom and reverse. Number two, obviously this is going to be a zone of resistance up and through here. But if and when it clears 1370, it's going to be a sprint, I think, about 1400.
Oh, yeah.
This is the longer term view. So we're coming down and attacking this line, connecting to December 15, December 16 lows. It wouldn't surprise me to see a brief, again, cleaning them out. You can see the RSI at the bottom here. This is a weekly chart. So the RSI as of yesterday was at 33. This is the lowest it's been since December of 16. So again, the technicals are getting extreme. You mentioned the gold relative strength of the gold stocks to gold. This is that ratio. You can see here's goes back to last September. A week ago, we broke through it. We weakened again yesterday a little bit just because the gold stocks got hit pretty good. I've been looking to be a buyer under this low here, which is 2180. Well, the low is 2177 on the GDX. And ideally, seeing the RSI get down to 35. So I think there's the potential of a very decent move in gold, 10 to 12 to 15% up. That's what's happened the last three times the position has gotten this constructive. And typically the gold stocks will do double that. One thing I wanted to touch
it's
on,
definitely, it's definitely a contrarian call, Jim, because, up until maybe a month ago, you didn't hear this. I mean, everyone was anticipating a 1360 breakout when it was knocking on the door up there. But since we've had this decline, the $1,000 gold, $800 gold bears, deflationists. Even some guys that I know are pretty good are saying, 1120. So, the bears have really come out of there's no one that is saying buy gold right now.
Yeah. Well, I mean, again, two things. My July,
except, unlike you, Peter Schiff, and Kitco are always buying gold.
Well, I refer to Peter Schiff as Peter Shrill. So he's one of the few people that I can honestly say I have very little, no respect. I find him annoying and obnoxious, and he's more often than not wrong. So other than that, he's a wonderful fella.
Yeah. Where do I sign up? Yeah.
Yeah. So
is that
right.
Yeah.
about, everyone was getting bullish, 1360 is going to break. And but
Right.
again, looking at the positioning, I saw the commercials shorting into those pops, attempts to get up there. And that's why I thought we would see that progression of taking one trend line out after another, just gradually beat the longs up and get them squeezed out. And I think we're just about there. But the July commentary, the title was Cyclical Inflation followed by Deflation. So I think deflation is coming, but it's not coming until we see a meaningful decline in economic activity. And, sooner or later, the Fed always raises one too many times. And when that happens, given the amount of debt, not just in the U.S., but debt to GDP ratios around the world are like the highest ever. So you got a meaningful slowdown in economic activity. Debt is going to become a real problem. And I don't believe the central banks have the same tool bag as they had in 2008. The Fed can't keep the Fed funds rate from 5.25 to 0. The Fed can launch another QE program. I'm sure they will. I just don't think it's going to be successful. When you look at the debt going from 9 trillion to 20 trillion, the Fed's balance sheet going from 900 billion to 4.5 trillion, and you look at how much it added in terms of GDP, it wasn't much of a bazooka, to put it that way. So I think deflation is the biggest risk going forward. Now I'm going to show you a chart. This is the Bloomberg commodity chart, and from the 2011 high. So in 2008,
it's my initials. It's my initials.
It is. So
TJP.
They were thinking of you.
I'm famous.
So the 2008 high was up here. Okay, so that's like from a big picture, 1 down, 2 up. But from the 2011, you can count 1, 2, then wave 3, 1, 2, 3, 4, 5. So since the January 2016 low, it looks to me like, hey, it's trading out a big triangle. And triangles are always a pain because you never know. There's always going to be one more leg. So potentially, this high right here about a month ago could be wave E. It also could be wave C. In other words, A here, B, C here. We're coming right down to this trend line connecting the January 2016 low, July 2017 low.
Great look.
So it could be A, B, C, D. We get one more, uptick, and then turn out the lights. All right. Obviously, it's very oversold on a weekly basis and so forth. But to me, this pattern looks like a triangle. It does not look like inflation's about to break out. And if we look at the shorter term picture of it, it's a little bit more clear. A, B, C for B, A, B, C for C, and that's why potentially C may have peaked here, and now we're in D. But yesterday we closed right on the black line. The blue line is just a little less aggressive in terms of the ascent line. It's very oversold. You've got some divergences on the RSI, so we maybe do a bounce. But to me, this is really worth watching because if we are about to have deflation, that is something that no one is looking for, and in the short run. And I think this would provide a clue that we're maybe headed that way. Clearly, the tariffs and what they've done to grain prices and so forth. And, people minimize, you see, that, well, it's only $32 billion of additional, tariffs, and as a percent of GDP, it's infinitesimal. I get all that. But what they're not capturing is the knockoff effects where, company CEOs are looking at what's going on and they're sitting and saying, you know what, maybe that expansion plan, let's wait a little bit. And so I think there's the subjectivity of not knowing how this is going to go. It's going the wrong direction. That's all we know so far. And I think it's causing some people to pull back. And that's what I stated in my July commentary. And the minutes of the Fed last week when they came out kind of said, yeah, they're talking about it. They're getting feedback from corporations that they're holding back on stuff. So when you hear the numbers,
they're not holding back on, Jim? Buybacks is what they use the tax savings for. Buybacks.
Yeah, I mean, that was the biggest joke, if you will. It's so easy to read. In 2004, They had the Homeland Investment Act. I mean, oh, isn't that a wonderful title? But 90%, over 90% of the money went for buybacks and dividends, even though in the law it was expressly stated you could not do that. So to me, this was an instant replay. Now, Japan did a tax cut for corporations, but they had a stipulation. You could only do buybacks if you gave your workers a wage increase. And, you know, to me, that's a probably intelligent thing, because big picture here, over the last 30 years, from the mid-'80s, we've seen a pendulum shift away from corporate America and corporations in general from being good citizens, making good products, and paying their workers a decent wage. They've shifted to maximizing shareholder value is the preeminent factor that's guiding most decisions. Personally, if you look at, you know, profit margins are at an all-time high, wages as a percent of GDP are at a 50-year low. And Henry Ford had it right. I'm going to pay my workers enough so they can afford to buy my cars. Sooner or later, and I think it's going to be when we go through what I think is going to be a very difficult time in the next 3 to 5 years during the next recession, I think there's going to be such a backlash that companies are going to be forced to kind of swing the pendulum the other way and start increasing wages, because ultimately demand drives economies more than anything else. Not government spending or anything. You need demand, and you need to pay, you know, better wages. And then unfortunately is not their focus. Instead, they borrowed trillions of dollars. There's more debt as a percent of GDP on corporate balance sheets today than in 2007. And so we're seeing, you know, the worm turn here. There was a piece in the Wall Street Journal in the last few days that companies that have been buying stock, their return on investment is the lowest it's been since 2011, and the stocks where the buybacks are the biggest are underperforming the S&P. So,
interesting.
You know, I think, I thought
it's kind of like the QE. After a while, losing its effectiveness. This is the same thing. Buybacks are not having the same type of positive effect on stock prices as they did. Just like QE stopped, really every dollar you spent, you were getting a lower return on QE too.
That's right. That's right. And so, you know, to me, these are some of the things that, you know, I like to write about, and because at some point in time, they're going to become very important factors, and the majority of people are not going to see it coming. I believe that the next decline, you know, when we get into the next recession, I think the market's going down by more than 50%. Again, it's overvalued. The leverage built up in the system isn't the same way as it was in 2008, but the tools to battle the next recession, not just from the Federal Reserve, but central banks around the world, are far more diminished. And I think, you know, what will happen is you'll have a leg down in all the equity markets. Central banks will ride to the rescue. Everybody's, oh yeah, look at the last time that worked out great.
Right.
There'll be a heck of a rally. And then the reality is this isn't working. And that's when it's going to be really ugly. And the social divisiveness that we're seeing, not just in the U.S., but around the world, I think is going to get magnified because when economic hardship befalls a lot of people, they react very negatively. And I think that the social divisiveness is likely to become far worse if this plays out. So, we're headed.
Jim, I hope I'm on my Haven Island paradise watching it all on TV, and you're welcome to come and hide out with me, you and your family anytime.
Well,
okay.
I thank you, and hopefully we're short because that'll be a making opportunity. You know, so,
it will be. There are once in a lifetime type thing.
Yeah, kind of a little bit like 2008. You know.
Yeah.
So, you know, central banks went on an experiment that's never been done. They were forced to do it. And you look at where bond yields are, and in Europe especially, there's a big adjustment coming.
Let me ask you this. I'm guessing with what's happening in Europe that they're the epicenter this time, you know, Deutsche Bank, Italy, everything happening there that, you know, ground zero is not here. Europe has more problems, then it goes to Asia, and we're the last domino.
Yeah, I'm glad you mentioned that, because I agree. I believe that since the last two big declines were initiated, if you will, in the U.S., the dot-com bubble in 2000, financial crisis 2008, that the next one is more likely to start overseas. Why? Because it'll probably catch most people by surprise. Oh, our banking system is really, really strong, so on and so forth. In Italy, I'm glad you mentioned it, you know, their debt to GDP ratio is around 135% or so. There's no way they're going to grow their way out of it. Their GDP is barely above where it was in 2000. So the last 5 years, they have failed to make a lot of structural changes to labor laws and the way business is done in Italy. And so they've wasted the last 5 years. And the net result is, you know, growth really continues to be quite poor. So they are definitely one of the candidates for a problem. And of course, China. And then last but not least, you have geopolitical tensions that I think will continue to build between the U.S. and China. And, you know, who knows how that plays out. The Middle East is another issue. So there's a lot of candidates. But the debt to GDP ratio is going to be what drags, I think, the global economy down during the next time we have a recession.
Jim, great interview. I encourage people to take Jim up on his offer, get a free issue of Macro Tides, and there's all his information. You can follow Jim at Jim Welsh Macro on Twitter, and there's his email address, jwelsh@smartportfolios.com. Great look and great discussion. Really appreciate you being here, Jim, and I look forward to continuing to read your excellent work every week. So thank you, my trading warrior brother. You're very welcome, man.
All right. Hey, thank you so much, and thank you to all who took the time out of the day to listen in. I appreciated the opportunity to share my thoughts and analysis. Have a great day.
Okay, good hunting, Jimmy. All right, everyone, that's a wrap here. All right, bro. All right, that's it. So remember, everyone, don't just count your pips, count your blessings. We'll wrap up the week TGIF tomorrow. Appreciate investing.com being with us. You're very welcome, Kareem. And see everyone tomorrow. Enjoy the rest of your day. I'm rooting for each and every one of you. Adios.